Good morning and welcome to our time together. I was working on some artwork for us this morning and lost a little track of time. So we will be revving up and getting rolling at 9 o'clock. So I'll give you a few minutes to get yourself organized, get your paper ready, whatever you need to do to be ready to go. And I'm going to put up our usual screen here. And we are back and it is time to get rolling. So great to see you this morning. Thank you for joining us. And we will be talking about the very important and exciting topic of money, in particular, keeping track of it and knowing how to do that. Let's get started as we usually do with our applied kinesiology. If this is your first visit here, welcome. And my name is Becky Amble, and I will be sharing just some ideas right now on getting our brain connected before we get into our topic of the day. Let's stand if you're able, and if you're not, stay in your chair. Anyway, let's just see if we can get this a little bit. There we go. And the reason that we do this is to connect both hemispheres of your brain and get us in the most optimal state of brain and mind that we can so that we can take in new information. And this connects both hemispheres. It's the only way I know how to do that. And it's called kinesiology. So first thing we're going to do, if you're able to stand, is we're going to connect elbow to opposite knee. And if you aren't able to do that, then just tap your hands. One way or another, it will connect both hemispheres of the brain, which, if you know much about neurology or any of the brain functions, that is going to put your functioning brain in a better state. All right, we've got that. Now, put your hands together and do a figure 8. Right, now, one that gets a little tricky, put the backs of your hands together, link your fingers, push forward and bring them back through. There are 2 more of those. All right. Link the fingers. Now, sometimes it's hard to keep those fingers together. Back of your hands. Link. Come through. Terrific. And now we can all get in our chairs and get ready to talk about that fascinating topic of money. Hold on, I need to get something here. All right, we've got what we need, I think. And let's start our screen share. Whoops, one more time. So there we are. Again, thank you for joining us today. Welcome, welcome. This is Ready, Set, Grow, group to work with businesses that are generally in the B2B space and doing less than $5 million in annual revenue. And today's topic is Master the Money. Here's our agenda for the day. I'm not sure if that thing is in the way, so I will move it on my screen. Our agenda for the day is our kinesiology. So we got the first thing done already, and we're going to talk about where we're at and then talk about financial management, followed by sales and expense projections. Then we will get into actual financial statements. And I know for some of us that will make our eyes glaze over, so hang in there. And then we will wrap it all up. And as I usually say, start out, have your index cards if you use them, of whichever size you like. I like these big ones, but I also have the smaller ones. If you've got a notebook handy, if you're using my journal, which has been a great tool for people to use as well, just join in with whatever you've got, and hopefully you have that already since you had a little setup time to get ready. If you're using a mind map, again, here is the basic mind map. This is on the 7 dimensions of life or wellness. And if you're doing this for financial statements, as we go through it, you could put in the center one, you could put income statement, and you could draw the branches around and see if that helps as a tool to remind you of different elements. And again, we're going to talk about all kinds of financial stuff today. This might be old hat for you. It might be new. It might be a refresh. Take it wherever you're at and use whatever information that you can. Here's our whole process. Once again, the first pillar that we talked about is called Get Ready. We talked about your hidden motivators, thinking like a millionaire, and what do millionaires think like? What are their habits? We talked about getting your customers to love you. Second step or pillar is getting set. And we talked about getting on target. Excuse me, that was your target market, talking about revenue streams that make sense and make money. We did that a couple times. And upselling and cross-selling magic, we did that, and we finished up some of that last time that we were together. And then putting it all together and growing your business. And that last session, we did finish up on cross-selling. We did the session called Do a Little to Get a Lot, which really wants to reinforce the point that we want to start with one thing, and we can start small and we can still have great results. Today, Master the Money. And then next time that we get together will be your A team, which will probably be 2 weeks since most of us will be observing a holiday in a week. Let's get started then. And what I want to share with you is some information here on financial management. We go, well, what is financial management? Let me adjust my camera a little bit. And we take a look at this, and why does it matter? Well, financial management is the process of 4 things. And I like the rule of 3, so you might be able to put these into 3. Planning, organizing, directing, and controlling financial resources to achieve our business goals and objectives. So again, planning, organizing, directing, controlling. I guess that's why one of the jobs in that world is called a controller. And in a B2B company, as well as any other company, frankly, financial management is especially important for ensuring profitability, managing our cash flow, and making informed financial decisions. The things that we're going to touch on very briefly, we're going to talk on budgeting. We'll get into more detail on financial reporting, cash flow management, and financial analysis. I'm going to dig just momentarily here on budgeting because we're going to go in more depth on the other aspects. And keep in mind, budgeting is important. I think the other statements and aspects we're going to talk about are a little bit more technical, a little bit more obscure possibly. And budgeting, most of us are probably familiar with that because we have to do that in our personal life. And obviously you can probably do some more research if that's an area that you think you need to get more information on. Involved in budgeting, you will put together a financial plan, and this is going to outline the projected revenue expenses for your business, for your company, for a specific period. Usually you do this on an annual basis. I think it's great to break it down into monthly and then roll it up into quarters and annual, because most of us really need to be on top of this. I think looking at it monthly is important. When you look at your budget, it is going to help you manage your finances and track your progress toward your financial goals and help you make informed decisions about spending and investing. And when it comes to financial reporting, the second point here, this is where you're going to generate, or your software will, or somebody that you hire might generate those reports, the financial reports that give you information on your company's performance. And this will be things that we're going to talk about: profit and loss statement, or otherwise called an income statement, balance sheet, cash flow statements. And financial reporting allows you to analyze your company's financial health and make informed decisions about your future investments and strategies and where you're spending money and all of that. Cash flow management is important, and sometimes I think we know this and we might not talk about it as a specific thing. This involves managing your cash inflows and outflows to ensure that you have enough cash on hand to cover your expenses and investments. And again, cash flow is critical for any business to ensure that you have the resources you need to operate and grow your business. And then the financial analysis, the last part that we're going to dig into, is to really take this great information that you have and identify trends, patterns, look for opportunities for improvement. We've talked before about the customer journey map, and you can use that as an area to look from a customer standpoint where you make improvements. So we're all about doing one thing to get better at running our business and serving those customers. Financial analysis then helps you to make informed decisions about investments, pricing, and other financial matters. So it is really important, and again, can be an area that some of us maybe don't find too interesting. You may know, or you may not know, that a number of years ago, I started a finance company for an organization out of California. And what I find interesting is it was a whole new industry here in the Midwest, and nobody knew what we were doing. It was a great opportunity, great fun. And so many people, because it was a very successful launch, so many people will say, well, you're a finance person. You started that company. And I go, well, really? I am an expert on figuring out how to make money for a business, figuring out how to grow it, figuring out what's going on with the customers and the market and all that together. And doing the financial side was less of a challenge and probably less interesting to me than figuring out how to turn this into a viable business and get it growing. So even though that was my time for a while, I like the strategy and putting it together part more than I like looking at the numbers. In fact, I like this quote: "I love bookkeeping, said no one ever." And frankly, some of it can be fun. It's just, for me, I feel like it takes too much time if I'm doing it myself. I've usually hired people. And in bigger organizations, it's great because you have accounting staff and accounting people, or at least an accountant. And for small businesses, frankly, there are a lot of really good resources out there if you need to do this yourself. And also some good resources if you need somebody part-time. All-in-one accounting is out there, integrated solutions, and other individuals. Keep in mind that without spending a whole ton of money, you might be able to just get somebody to take this part for you, so that then you can review things and not have to do the sort of the data input part. First thing I want to talk to you about is a sales projection calendar. And this maybe goes a little bit more back into that whole topic of budgeting. And it's so important that we figure out what our sales are projected to be. And you can use this There'll be something in the guide, and I believe the one I put in the guide is white, so you can print it off and it'll be easy to work with. I use the green because that's the color of money. Anyway, break down every month of the year like this, or make your own. You can do this in an Excel spreadsheet or a Word table, whatever works for you. And then make sure you look at your results quarterly. I mean, you want to look at monthly, and you probably want to then at least roll it up into a quarterly number. And then, as you can see on the bottom, an annual. Let's just take a look at an example. So let's say that you want to have an annual revenue of 120,000. Well, to keep it simple, let's look at what that comes down to, and that's $10,000 a month. No big mystery on math there. And that ends up being $30,000 per quarter. And you can use whatever numbers are appropriate for your business. Maybe you need to add a zero or several zeros. Maybe you're at the size where you're doing $1 million a month. And if you are, hey, congratulations, that's awesome. Keep in mind, you want to think about what you're doing every month. And you might have some seasonal fluctuations and some ups and downs, and that's only something that you would know. Make your adjustments. So if you were on the smaller side and instead of doing $10,000 every month, maybe January is a slow time. Maybe that's 5,000 or 7. And so make your adjustments wherever they need to be to hit the number. That's your ultimate annual goal of 120. Or, like I said, put down how many millions you're looking to increase or have in your revenue this year. Another thing is to do pretty much the same thing and do it on expenses. And I put this in orange because I thought, well, it's kind of like red, and expenses tend to be things that can put us in the red, or we look at as an outflow of money. Again, do this by month and sum it up by the quarter so that you can go back and review and have your annual number. I didn't put actual numbers in here. You can do that. It's the same concept as what we just talked about. What we're going to do next is dive in on financial statements. Let me just take a minute here and stop. If you've got, your index card or your highlighter, and there's anything that we talked about that you jotted down in notes, if there's anything that just struck you on this, we just talked about your projection calendar, mark that up. If you need to give yourself a reminder to go look in the files or the guide section on Ready, Set, Grow on Facebook, do that. There'll be some information there for you. And again, this is ready to go if you haven't got one. And sometimes that just makes it easier for us to get started when we have a form that all we have to do is print it and start filling it in. And use some time. If you haven't done this, take even 5 minutes and just brainstorm what you want to have on your monthly and how that rolls up to the quarterly. Think about some expenses that you know you have. You might have an internet expense, you might have a phone expense, depending on what your business is. You might have machinery, you might have rent, all those things, and start just plopping them in here. This at least is a starting point. And again, I know everybody's at a different point. Some of you might be going, well, this is too basic for me. Hey, it might be. We will move on. Next, we're going to talk about what is typically considered a financial statement or a business statement, and those are the income statement, the balance sheet, and cash flow. So let's get started here with an income statement. And I have taught people complex stock trading strategies, probably that nobody else I knew around the whole metro was doing. And I had to figure out how it made sense to me and how to boil it down and how to make it step by step by step. And I've tried to do that a little bit here with, well, not a little bit. I've tried to think of ways to make the income statement and P&L just easier to access, because 65% of our population is visual. And I'm thinking, how can we make this look right in a way that it's going to make sense? Well, anyway, remember, income statement and P&L is the same thing. So if you're talking to your banker, your accountant, or somebody else, just remember income, profit, and loss. What do you want? You want a profit. What is that? That's income. Again, this might be simplified. I'm just trying to come up with little ways that we can all use a memory jogger. And an income statement shows how much money your business makes and how much it spends over a specific time period. Usually, I think it's great to do that on a monthly basis, roll that up as we did with the previous example here into quarterly, roll it up into annual. And it shows a snapshot that reveals your business's financial health at a point in time. Balance sheet looks at a point in time too. Remember, income statement is how much money you're making. Basically, are you profitable? What's it look like? And just as another visual, maybe this will help clarify that and give you, again, another little memory jogger. Think about your revenue is green, that's your money, expenses are the red, and when you subtract out your expenses from your revenue, that is your income or profit. And of course, we want that to be green. There are some pieces to the income statement, and I put the plus and minus over in the left margin, again, just as a little memory jogger. And again, this is pretty basic stuff. So if it's too basic, no problem. Maybe you can grab yourself a cup of coffee as we talk about this. And let's just go through this for anybody that wants to know a little bit more about it. And the first thing is revenue and sales. That's going to show up on top. And when you hear people talking about top line, that's what they're talking about. Okay. There's a bunch of jargon thrown out there, and you may totally know all this, or you might be going, okay, now I get it. Anyway, let's look at revenue and sales. This is the money that your business earns from selling its products or services. It's the total amount of money that comes in when customers buy what you're offering, what you're selling. This is the starting point for your income statement, and it represents your business's top line, as I mentioned. So again, when people say top line results, bottom line results, a bunch of more jargon, keep in mind revenue, top line, got the green plus sign there because you want, well, that has to be a plus. Nobody's going to pay you a negative amount. All right, cost of goods sold, that can be a bit of a bugaboo, and it's typically referred to as COGS, C-O-G-S. Let's talk about this. So these are the expenses directly related to producing your products or service that you sell. For example, if you are a prototype manufacturer and you've got a 3D printer to crank out some prototypes, your cost would be the equipment, and you're going to have materials to feed into that 3D printer. And if you're familiar with that, it can be plastic, it can be metal, different kinds of metal, stainless, titanium, all kinds of different materials. And you're going to have those supplies. Then you're going to have somebody run the machine. You might have to have somebody do some design work. Those are all parts of cost of goods sold. If we're in a simple business, or use a simple example, because most of us here are in the B2B space, but let's just say that you had a bakery. Well, if you're making bakery or baked goods, you're going to have ingredients, you're going to have packaging, and you're going to need somebody to run the equipment, to make the machinery. And again, it's our example on making prototypes. I forgot to mention, you would probably have packaging after you get the prototype designed, or some delivery, some kind of, maybe it goes on a pallet, maybe it's a bigger thing. That is your cost of goods sold. What does it cost you to make the product or service? Gross profit, then, you can see, is another plus, because that better be a positive. You want to have the money you're coming in, the cost then of producing the product or service, and you subtract that out. That's why you got the little red minus, and then you end up with your gross profit. Okay, that's great. And that is after you consider some of your expenses. There's going to be other things that we're going to talk about here. All right, then operating expenses. All right, to hopefully not get that more confusing. These are costs that you are going to pay to run your business on a daily basis. So if you are manufacturing, you know that you have rent, you have overhead like lights and all that kind of stuff. If you're running an operation that is a service business and you're running it out of your home office, you would have expenses, maybe computer equipment, maybe you're paying for internet service, your cell phone service. If you're running a home office, you might figure out how much your space that you run your office in is as a percent of your total home or apartment. So you will still have those kinds of expenses just to run things. All right. So when you're thinking about operating, think about running a business. What are those things just to keep the doors open? A lot of times people say. After that, you want to have a positive, and this is called your operating income or operating profit. And this is the money that your business makes from your core operations after both the cost of producing your product or service and those regular operating costs of running your operation. And this will help you see how well your business is doing without considering things like taxes and interest. And again, in the jargon world, this is often called EBIT, EBIT, earnings before interest and taxes, EBIT. And your banker or other people will say, what's your EBIT? Or they will say, what's your EBITDA? And that's EBITDA. And that, the last two stand for depreciation and amortization. So you're adding in some additional things, or before you subtract those out, that is the term EBIT and EBITDA. Otherwise, here also would be your operating income or operating profit. All right, is that totally confusing? I just want you to know some of the terms. So if somebody says, well, what's your EBIT or EBITDA? You're thinking, what is that again? Oh yeah, that's before we take out the additional expenses of interest, taxes, depreciation, and so on. Let's look at the next thing. And that is where you will have other expenses. You might have other income and you might have other expenses. So if there's something that you make money on, maybe you've got royalties, you license something, and that might come down here under your other income. Maybe you've got an investment account because you had a good year and you put some money into some kind of investments. That would probably come here under other income. And other expenses, then it's going to be things that haven't sort of been accounted for in other places. And another way that you might have made some money is maybe you had a building or maybe you had some equipment that you sold, and that could produce income. Then our favorite topic down here, another negative, is taxes. You're going to have to pay taxes on the income that you made. And of course, I think everybody knows that's your income or your sales after you've taken out your expenses and have your net number. And the very last number, sometimes people have net profit before taxes and net profit, final net profit after. I think this way makes more sense, but use whatever makes sense to you. So your net profit is really what do you have after you've paid everything, including your taxes. Anything here jump out at you? Anything where you go, oh yeah, I know all this, or is there anything where you go, oh, yep, good memory jog, good little tidbit. There is, mark it in your notes. And here is a description. You're going to be able to get something pretty much like this in the files or the guide section on Ready, Set, Grow. So if this is helpful, this is like your crib sheet. And go print this off if you'd like it, save it on your computer. I think the one that I put in there is in color. If you download it, I think you can probably take the color off if you don't want it and you want to print it. So just again, remember revenue and sales, the money you make from sales, that's money coming into your business, cost of goods sold, cost of what it costs you to make whatever it is that you sell, gross profit, money after that is deducted, operating expenses, again, the basic cost of running your business, operating income is your profit after you deduct this. So it's just like you kind of go down that funnel. And other income and expenses, any gains or losses that might not have fit in the other part of your operation, your accounting. And then your net income, money left after all the business expenses and taxes are subtracted. And again, put your taxes wherever you want them, but we know the final net income or net profit is after you've paid your taxes. Let's just take a quick look. Did I want to use that one? This one's a little bit easier to see. What you want to do, and we're going to talk about that too, is you want to monitor and you want to track your results. So in this one, look at your sales, and the sales actually went down. And then you look at your returns, they actually went up. It's not a good combination. And your sales discounts in this company, I'm not saying yours, actually went up. So sales are down and returns and discounts are up. That's not good. Obviously, that meant the total revenue was down. And whoops, then look at your expenses. I didn't create this, so I've got some problems with a little bit of the math over here, but we'll just take it for what it is. And then your expenses, salaries, wages, depreciation, amortization, office expense, rent, travel, a number of other things. And again, you can just look at this where, hey, at least salaries and wages went down. Whoa, depreciation went up and office expenses came down. So a little bit of a mixed bag. Then look at the total expenses. They actually did come down and you think, okay, well, that's probably a good thing because revenue was down. Hopefully we're not spending more money and having lower revenue. Net income before taxes, you can see that number and the taxes on the income. Again, that's all calculated based on the tax rate. And net income before taxes was a little bit lower than last year, and their net income down a little bit. They still had a positive year. It just was smaller. And what I like to do, if you've got your stuff in Excel, and I would guess, not that I am an expert on QuickBooks or any of the other ones, is that I think it's great to look at a bar chart because it's so easy to really spot trends. And you can see here in this company, the first part of the year, the first quarter is lower and it's kind of a building process. And the second quarter, they're up and kind of just sitting there. Then the third quarter over the summer, they have a bit of a drop and then they take off again a little bit. But their third quarter is where they really start humming and have more revenue. Again, take a look at this stuff and see what you can see. This one I like because it's in color and you can see the revenue is the blue teal and the expenses are the green. Of course, I didn't make this chart, so I would have put the money part in green. And you can see where in that last year of 2022, where we have the information, that their revenue increased quite a bit more than their expenses. That is a good trend. And again, just a little bit of a visual. You want your revenue side, if it's a bunch of boxes stacked on each other, you want that to be the biggest pile that you can. You want your expenses to be a smaller one. And obviously your revenue is on the teeter-totter. It's going to weigh down that end. Here's another one that I think is really kind of interesting. Again, the lighter color is income, the darker color is expenses, and the red line is profit. And just look at this. How cool is that? Well, it would be nice to have this trend continuing all year. In July, they had pretty doggone good income and really low expenses. So obviously, that was their most profitable time. Then as time went on, the revenue kind of came down. October, they had another great month, and expenses were down, but started to creep up towards the end of the year. And maybe this is a seasonal business for some reason. Their November and December were down, and actually their profits still positive, but much lower. And this kind of chart just puts it all together. If that makes sense to you, again, use whatever is a good tool for you. Jim Rohn, one of the masters in business, says that success is neither magical nor mysterious. Success is the natural consequence of consistently applying basic fundamentals. And one of those is really looking at our financial information. So let's take a quick look here at how to use financial statements. I think in the review there, I kind of gave you a couple ideas. So let's just wrap this up. You want to track progress. So think about asking yourself, is my business making money, more money than it's spending? And you want to have a positive number at the bottom of your statement, of your income statement, profit and loss. Are you growing over time? The income statement answers those questions. And again, if you've got that bar graph, you can see, hopefully, each month the revenue is getting higher and higher and higher. Spot some trends. Again, we looked at the statements, and you want to look and see, are there certain expenses that are rising higher than they really need to be? Is there something going on that you need to be aware of? Are sales slumping? What's the difference in sales and revenue? Is there, like we saw in some, is there a seasonal aspect? The income statement can help you catch those trends early before there's a problem. And I mean, it could be a symptom. It could be just a blip. And then to plan ahead, by understanding your financial health, you can make smarter decisions about pricing, expenses, and investments. Excuse me. And what are some tips, kind of things very similar that we talked about here? First is to have regular check-in, review your income statements regularly. And I would say you do that at least monthly. When I do turnarounds, I think we were probably looking at things every day, and you can get a little bit myopic and a little bit carried away. However, when you're doing a turnaround, you're on a pretty tight leash, or the company is. So you need to be on top of that. Compare periods, compare income statements from different months or different years. And this is going to help you see how your business is changing over time. The third point, adjust if needed. If your expenses are too high or profits too low, use your income statement to help figure out where you can make changes. And then talk to experts. If you're unsure about something on your income statement, it's okay to get help from accountants or financial experts. In fact, that's a great idea. And if you have a bank, sometimes they can be a good resource. It depends, because everything varies a little bit. But also the small business development centers, those are statewide. And find one, the Small Business Administration. A lot of times you can get consultants through SCORE that can be helpful. They also have all kinds of documentation and forms and reports and all kinds of things that you can use that will help you if you're putting this together yourself. And this one, okay. The revenue roadmap, again, here, just another little visual, trying to come up with something that helps make the visual. Starting at the top here, here's all your revenue. And over here, what looks like a factory, cost of goods sold, what's it cost you to make your product or service? And you move along this road, and there's operating expenses, those things like we said, just to run an operation, rent and equipment, computers. Keep going down there, got to pay your taxes. And at the end, you want to run into that pot of gold, have some money. Let's talk about a balance sheet. And a balance sheet, well, let me just hold on a minute. Income statement, anything there you made notes of, anything you want to put on your index card where you're going, oh, that's one thing I forgot that I need to check on, or this would be a good time to call somebody to set up an appointment at the SBA and get a score advisor, whatever. Is there anything that struck you? Let's take 30 seconds. Okay, let's talk about the balance sheet, another financial tool that we have in our, I guess, in our arsenal. And a balance sheet is like, I see the bottom one, family photo. It's a picture at any point in time. So keep in mind that both the income statement and the balance sheet are based on time. And the balance sheet is like that financial snapshot. Again, here's a visual. Assets, the things that you own and are green, represent money. Liabilities, things you have to pay. And owner's equity could also be in green. Owner's equity is basically what you have left over after you have all the positive things and you subtract your liabilities. Owner's equity is what you have left over. Think of it a little bit like if you have a car or a home loan, if this is a different concept for you, a new concept, that you're paying off, let's just say your car loan, you're paying off your car loan. And let's say the car was a $30,000 car and you've paid off $20,000 and you owe 10. Well, then your owner's equity is the difference between the value of the car and what you still owe. In that case, I guess it would be $20,000. Cars aren't the greatest because they depreciate over time. Usually houses increase, probably a better example. Let's also take a look at this image. And what you really, really want is over here on the left side, the assets, you want that to be the biggest bubble that you can have, the biggest circle, because the bigger that is, when you subtract out your liabilities, which you want to be smaller, then your equity is going to be a bigger circle. Because again, remember, whoops, assets equals liabilities and owner's equity. So these two have to add up to your assets, and you want your equity to be a bigger circle, obviously, than your liability. Well, you want assets to be big, liabilities to be smaller, and then your equity to start growing over time. Here's just another way to look at it. Liabilities plus owner's equity equals assets. Like I said, these two have to add up to assets. Sometimes this seems to not make sense, but hopefully it will make sense to you. And here's your cheat sheet. So you can get this on our files section. Let's just kind of go through this. This is a bit of a bunch of stuff. So let's take a look here on the balance sheet. And all the things here you can see on assets. And they're broken into two categories, current and non-current. All you have to do, jump over here to the far right and look at time frame. Current assets are things that you're going to use within a year. So it's cash, money you have in the bank, accounts receivable, money that people owe you, inventory, what you've got that's in your warehouse, ready to sell, or workshops that you have ready to go. And it's a little hard to call that inventory, but you get the picture. Prepaid expenses, so things that you might have paid in advance. All of that is something used up within a year. And your non-current are things you can see listed here, like property, plant, equipment, intangible assets, even investments. If you said, well, part of my strategy is to invest 10% of my revenue in investments. I don't know, maybe that's what you do. Just keep in mind the non-current also are things that you own, O-W-N, own, and they are going to be used over more than 1 year in time. And it's pretty easy if you've got plant and equipment. That all makes sense because, that's a long-term thing. Then let's take a look at liabilities. That's broken down to current and non-current as well. So current, you're going to pay that in less than a year, and non-current, that's going to take longer, more than a year. And liabilities are things you owe, O-W-E. So we got one letter difference between owning and owing. That is things like accounts payable, short-term loans, accrued expenses. So those are all things that need to be paid within a year. And as we know, sometimes sooner than that. Non-current, these are the longer term things like a mortgage or equipment that you financed, bonds, deferred tax liabilities. That gets a little more complicated. And then finally, the owner's equity. Did you put any money in? Did you need to do some seed capital yourself? Did you say, well, I'm going to have to buy this equipment myself from my money, not from what the business is generating? Retained earnings is when you're making money and you put it back into the business. So let's say that you made $10,000 and you said, okay, I'm going to take 5 of that and buy new equipment. Add zeros because that's probably what you would have to do. Drawing and withdrawal, so money that you take out. Let's take a look here at a sample balance sheet. Okay, and really the thing is here again, look for a trend. Look at the cash. All right, that increased over the 5-year period we've got here. Accounts receivable also increased. Hopefully you can see that okay. Inventory also increased, and you go, well, those all went up. Is that good? And you go, well, because you were originally selling under 60,000 or 60 million, whatever, and you have basically double that. Yeah, that makes sense that accounts receivable and inventory might go up. There's a whole other dimension of inventory we won't get into here. Current assets, so that all gets added together, and you can see it went from 70 thousand or million to 158. Doubled in 4 years. 5, sorry. And then property and equipment, that went down, obviously, because over time, it's like having a car, goes down in value. And your total assets, again, look at that. All right, that went up. Then your liabilities, again, I'm just going to look here at current and see, okay, that went up. Long term, that went down. Oh, cool. So the short term, the current liabilities went up because you're probably having additional expenses for buying equipment and things or materials to increase your sales. And then the long term was probably down because you're paying off that. That's like paying your mortgage. Equity capital, just going to go down here to the bottom, your shareholders' equity, that also increased, that more than doubled. That's a good thing to see. And then you can take a look here at, obviously, the main thing is this bottom line has to equal your total assets, where we've got the blue arrow. All right, lots of information there. What does all this mean? Well, again, what can you learn from a balance sheet? Let's take a quick look at that. The financial health of your organization. Again, compare your assets and liabilities, kind of go through like we did that example, and you can see that your business has more value than debt. Yay, yay. And trends. All right, look for some trends. Are your assets growing? Are your debts decreasing? What kind of trend? What's going on? And that's where, again, if you've got multiple years, the example I showed you is really, really easy to look at, and we need to do that. And sometimes we don't spend so much time looking at things as we need to. Making smart decisions, again, because we've got better information, we're going to make better decisions about, is this time to buy some new equipment, buy new computers? Is it the time to spend money? That kind of thing. And investor and lender relations. If you do have bank financing or some other source of financing, this helps you communicate to that source, and they're going to feel more comfortable the more you know about what you're doing, and the more that they then get informed in what you're doing. Looking at all of this, just think about, again, how you want to have your assets growing and you want to have your little liabilities decreasing as much as possible. Again, if your assets are growing, liabilities are probably going up. This statement, the balance sheet, is just one piece of the financial puzzle. To get a complete picture of your business's financial health, you want to use the balance sheet along with your income statement, which shows, again, your profits and loss, and the cash flow statement, which tracks money going in and going out. Anything here strike you that you want to remember? Well, we're moving along. Let's talk about, again, just basically you start your business, you get it to grow, it keeps growing and growing, and there you have the money tree. If only money grew on trees. Let's take a look here at cash flow. And this is what I was working on this morning. I was working on a bucket, and I was not having my artificial intelligence quite get what I wanted. And I'll probably add some of that. Anyway, think about your cash flow as a bucket with piles of money coming in the top. Of course, that's the dream. That's the image we all want. If you do visualization, you might use that. All the money coming in. Then think about this bucket with little holes in the bottom. That's where the money goes out to pay bills. And if you can keep those bills low and have less money trickling out the bottom, so much the better. Versus the bucket where you get piles of money coming in and you got big holes in the bottom and piles of money is going out. Then we have a problem. And a cash flow statement, as you can see here on the fourth point, is like a report card for your bucket of money or for your business. And it really helps you figure out what do you need to be doing. So simple in terms, the inflows in a cash flow statement is basically what's the money coming in. So you need to know, again, your revenue and what you're selling and all the things that are generating money coming in for you, and outflow. What are all the things that are going on that you have to pay, the money going out the door, and that gives you your net cash flow. And again, this is important because it keeps your business alive day to day. You need to have a positive cash flow. You need cash to pay if you've got employees or contractors or whatever your structure is, to buy supplies, to cover operating costs. If you are even running an office out of your home, you've got rent to pay or a mortgage for your house. Have you got enough coming in that at least that part you allocate to your office space is helping to cover that? If your business is profitable on paper, you can still run into problems if you don't have enough cash to pay your bills. In fact, sometimes companies that have fast growth have cash flow problems. It helps you plan for the future and really gives you a way to look at where your money is coming and going. It allows you to plan ahead if you're having a slow month and you know that you might have a seasonal business and you can anticipate and you can plan for that. Here's just another example. I was trying to come up with an image. So on the left, here's all those people that are so excited to do business with you and give you tons of money. Comes over here to your business, this corporate tower. And then what happens? It goes out to pay rent, to pay taxes, to pay wages or contractors, materials, whatever you are doing. And again, it helps you pay your bills and keep your business running on a day-to-day basis and cover your expenses without running into trouble. You don't want to run out of money by the end of the month or whenever you're anticipating money coming in from your sales. So a few things here on this one as well. Some ideas to keep in mind are to do regular check-ins, just like all your financial statements. You just gotta, as much as you like or don't like this, you have to keep up on it and plan ahead as you look at the cash flow and you know things are coming and going. And again, this is back to when we did that first exercise, or I gave you the sheet of having your sales projections and your revenue projections. You gotta really have an idea of what's coming in and what's going out. And I know you do. It's just a matter of the discipline of putting it together. And manage your payment terms. This is another thing that you could do, is try to get better payment terms when you are buying things and need to pay somebody for supplies, time, whatever you're doing. And also to act on negative cash flow. If you see that your cash flow is getting negative, you don't want to panic. You just want to look away for ways to cut unnecessary costs or explore opportunities to increase sales. And we have talked about in the past ways to increase your revenue. Okay, any quick thoughts or anything there that struck you as a reminder, a new idea, anything that you want to be sure to remember? Write it on your index card, highlight it, star it, whatever. Anything new. And I went through this very quickly. And I know some of you know this like the back of your hand and some of you don't. You can put everything together in a spreadsheet yourself. There are great free resources. I think I would, if you're in a more of a startup in a smaller business and don't have huge revenue at this point, like let's say that you're maybe at the point of struggling to cover your expenses even and make a little bit of money and then grow the business, go to the Small Business Administration. They have all kinds of reports and they have workshops you can go to and they have forms. Use them as a resource because they're free and go from there. And a good quote I like from Thomas Edison: opportunity is missed by most people because it dresses in overalls and looks like work. Yes, doing stuff with these financials is work and it might not be what you love doing. I used to hire my neighbor when she was 14. I used to hire her to do my bookkeeping. I'd set up my chart of accounts and all this stuff because I'm a little bit anal on all of that. And at least having taken accounting classes and so on in my undergraduate degree, I kind of knew what needed to be done. And I just thought it was great. She would take care of getting all the data input for me. So keep in mind, you can be creative if you're in a smaller business and startup and trying to get all that to work for you. I want to talk about a couple of examples here. So we've got a little bit of time left before we wrap up. So I want to talk about a company, a small business that said, our profit margin has been declining over the past few quarters. Again, that's another thing. They're watching the financials, so they see this trend and they're going, don't like that. So what they did was they analyzed the income statement and identified their cost of goods sold. Remember that. And they realized that the costs had been increasing and the revenue had stayed relatively flat. Now, a lot of us over the pandemic had costs go up. Did you raise your prices? Some businesses did and some didn't. That would be an easy one to look at right now and identify as a problem if this is going on in your business. So this company, anyway, because this wasn't necessarily pandemic related, the company was experiencing rising production costs or inefficiencies. And they decided to dig into this, and they found out that one of their suppliers had increased prices, and that resulted in them having higher production costs. So what they did in this case was the business owner negotiated with the supplier to get a better price and also started looking for other suppliers that weren't going to be pricing as high. And as the result, the company was able to reduce their cost of goods sold and increase their profit margins. The other thing I would say they could have done was to increase prices because, frankly, everybody's doing that now, aren't they? All right, let me see. All right, I want to share another example with you, and this is on cash flow management. So think about this company. It's a small manufacturing company, and they are having rapid growth. Remember when I said you can have cash flow problem even if you're selling like crazy and growing? That's what happened to this company. And they were generating substantial revenue, yet they were having those cash flow issues. And they had a negative cash flow from operations over the past few quarters. So they noticed this. They decided to analyze their cash flow statements and identified that the company's cash flow issues were due to a delay in collecting payments from customers. That's it. Well, not a cardinal sin, but it's not a good situation. So the company's accounts receivables are high, and some customers are taking longer than expected to pay their invoices. To address this, the owner implemented a new billing system that sends out invoices promptly and tracks payments more closely. Then the company also offered discounts to customers who pay invoices early. That's still being done. And this change has resulted in a significant improvement in their cash flow, and that allowed them to meet their financial obligations and invest in new growth opportunities. So we can be all excited about having new sales and revenues up if we're not getting the invoices out, if we're not collecting, if we have been selling to companies that have bad credit. That's not a good combination. Anyway, in summary to this, they were looking at their financial statements, and understanding financial statements is essential, obviously, for business owner investors to make informed decisions about our finances. By analyzing income statements, balance sheets, and cash flow statements, we can identify potential risks and opportunities for our businesses and take action to improve the financial performance of our business by really digging in and looking at that. I wanted to just share a quick one too. Another example here is that, well, the finance company that I started was all based on accounts receivable. So there's things you can really do to make sure your receivables are functioning well. I would say try to stick to 30-day terms. I absolutely get crazy when I hear that big businesses are putting the hammer on small companies and demanding 60 and 90-day terms. I think that's just unethical, frankly, because they're asking a small business to finance them. Do they need help with financing if they're one of the big companies? Not likely. That's just my pet peeve. It really gets me upset. One of the things also that we want to take a look at is managing seasonal cash flow. So I've got a retail story for you here. A small retailer that sells winter clothing and accessories. So they obviously have a seasonal business, and they experience seasonal cash flow fluctuations with high sales and cash inflows during the winter season, probably in the fall leading up to that, and then low sales and cash outflows during the summer, obviously. To manage this seasonal cash flow, the business owner creates a cash flow projection that anticipates the high and low cash flow periods. And again, you could go back to your sales projection and your expense, just put that stuff together and you have your cash flow. And anyway, so they reduced their expenses during the low sales periods by reducing employee hours, cutting back on any promotion and advertising, and negotiated payment terms, better payment terms with their suppliers. And again, some of this stuff is easy to do, some is not as easy. They also were practicing proactive steps to boost sales during the low season, such as offering some kind of summer sale on their winter clothing and promoting other products that were popular during summer months that they did have that weren't totally seasonally related. And these strategies helped the business to manage its cash flow more effectively. And that enabled them to cover their expenses during the low season and invest in growth opportunities for the high season. So they were able to really figure out how to manage this. Effective cash flow management is critical for a small business to ensure your financial stability and growth. And by tracking and forecasting cash flow, reducing expenses, and really looking at managing any seasonal fluctuations, a business owner can maintain a healthy cash flow balance and position themselves for success. A lot of this is just looking at the information that you have so that you know what's the real world, because that's the only way you know it, is looking at your data and then coming up with ideas and planning and strategizing so that you can better manage the cash flow. And I mean, it really comes down to just managing the financial condition of your company. And of course, some of the things that you want to do is to reduce expenses. You want to manage seasonal cash flow. You want to set some goals so that you are identifying what you want to accomplish in your financial situation. Manage your inventory and costs. Again, if you can negotiate good payment terms, collect on time, get good terms, maybe you can get things a little slower for you to pay. And then improve on your sales and marketing, in particular, if you're doing any promotion, advertising kinds of things in your marketing, really look at that and make sure you're getting the results. And managing your debt. So there's a few things that you can do. Invest in technology sometimes can help become more efficient. A number of things here I want to share with you. Just this list, you can get this on the website. I'm in the Facebook group. I don't know anything really about these. This was a list put together by Forbes magazine for the best accounting software in 2023. All right, we are at a wrap up. We will be back. I will have to let you know, because I can't remember now. Do we have 2 holidays that come on a Monday? We'll have to wrap up. I wish this would have been timed so that we could have our last session, because we're going to have probably a 2-week gap. Anyway, make notes. Was there something new, something to review, something that you thought about doing before and now you've been reminded? Thank you for joining me today, and I look forward to seeing you probably, gosh, it might be 3 weeks. I'll let you know. And if you have any questions, put them in the Facebook group. You can always reach out to me. Thanks for being here, and happy holidays for whatever holiday you celebrate. And we will see you next time. Thank you.